Welcome to this special edition of the IA Global Asset Management's podcast series. In late October of 2024, IA Financial Group will launch a new Canadian small cap segregated fund strategy managed by star manager Marc Gagnon. However, the track record of this strategy dates to a decade already. I'm Rose Marcello and I'm a client portfolio manager with IUGAM. And with me today is, of course, Marc Gagnon, portfolio manager, North American Equities. Mark is an award winning portfolio manager with a long track record in Canadian equity, real estate income, and small cap strategies. Thank you for being here, Mark.
Oh, it's my pleasure, of course.
So, the goal of our podcast today is really educational. We want to help advisors familiarize themselves with this strategy ahead of meetings with their clients. For that, what I suggest is that we'll go over your investment philosophy, your process for security selection, how you add value, and your outlook for this segment of the Canadian equity market. Does that work for you?
That works fine for me.
Yeah. So my first question has to do with your investment philosophy. Could you explain to investors why you do what you do when it comes to Canadian small cap?
Yeah, I think it can be summarized pretty easily that I'm trying to beat the small cap index. So it's what we call a relative fund management, but with as less risk as possible. So we're not trying to go, for the home run. We're trying to make sure that we monitor our risk. And, how do we do that? First of all, diversification is really, really important. So we want to be, really present in all the sectors, and therefore try to not let one specific portion of the index being empty in the portfolio. So if for whatever reasons something is going on there, we're not there at all. So diversification is really, really important for us, but also added value. And also at the security level, we're interested, of course, to add value. That's probably where we add, the most value after all those years in the fund. So we would like to invest in companies that are not in the index. That's something that we allow ourselves. So sometimes smaller cap. And, if we don't like one company in the index, we are certainly not concern and all to not own it. It's really not at the company level. It's more at the sector level that the diversification becomes important.
Speaking about security selection, could you talk to us about your process and what criteria you use to identify investments that you're interested in?
Yeah, we're mostly, and I could have also mentioned that in the philosophy, we're mostly growth investors looking for price appreciation. So how do we find that growth? It's interesting. We like to find it in what we call themes. It can be, something that is changing in the economy. So, for example, let's talk a bit about AI. AI is something that creates, a lot of interesting comments these days. A lot of energy also around the different stories. We like that, but we're not going to just play AI, for example, with a company that is involved in building data centers. It can be, for example, company involved in the production of electricity, for example, some materials like transformers and things like that, because we know that AI will increase the demand of electricity in the upcoming years. The last 10 years in the US, demand was flat. Now we know that it's going to increase. So therefore, we're interested by that what it means. It means also maybe more natural gas, because one easy way and probably one of the fastest way to produce base electricity is natural gas turbines. So this is the kind of themes that we like and we're looking for. But overall, if a company is part of a team or not, one way to realize if there's value is we still use the same tool, we've been using for a long time. In actually in all the mandates I'm involved, it's a DCF that we have built that doesn't really need a lot of hypothesis to be built and be able to estimate the value of a company. But what's interesting, we use it. What's interesting and a bit different, we use it with three different scenarios. One is like the average scenario where if things are going okay, but nothing super crazy there. If things are going bad is our worst case scenario. That's usually represent the floor valuation. And lastly, we do a best case scenario. Kind of imagine a rosy scenario with rosy glasses where everything is going perfectly, and what is the top valuation we can hold for that sector. And that's help us to realize, when to buy, for example, when the price on the market is somewhere close or in between the worst case and the average case scenario, when to sell. That's another thing because selling is not always easy. When to know when to sell. So when we get close to the or even above the best case scenario, and also that gives us a view of what's the operational risk of that company because those three scenarios gives us really a view of what we can gain, but also what we can lose. And that's the basis of estimating the risk of a scenario, a company. And when I was talking, so deeply about being focused on risk management and my philosophy, when you ask me that question, that's really a tool that help us to figure that out. Are we not only well diversified, but what is the risk of our individual parts of our portfolio? And that tool helps a lot. Helps us a lot. Sorry about that.
It helps you a lot. We
Yeah.
got it. So,
Yes.
so security selection is key to our process. You are really a bottom up type of manager. But
Yeah.
once you've selected that, could you tell us about how you then build portfolios to be diversified? If diversification is actually a key element for you, or you want to give your portfolio a tilt, how do you build that portfolio after that?
Yeah, we make sure that we are exposed to all the possible sectors, in the index where the index is invested to. Of course, we're going to overweight and underweight some. Some are more exposed to the economic cycle, for example. We're going to bring that part of the analysis or that type of the analysis in the process. And portfolio construction is at the level or some of the macro view can have an impact, but we're never going to go like to zero in a sector that is important in the index, and that's really important to mention. But that's certainly the place where sometime, for example, as I said, we can be a bit underweight commodities, for example, because it's really not the time to be in those sectors, for example, when you're really at the beginning of an interest rate cycle, interest rate gonna go up, like we witnessed in 2022. It's not exactly where you want to be. So we're gonna incorporate that view in the portfolio management. But as I said, it's not gonna be that we're gonna shy away completely from those more cyclical or economic sensitive sector, but it can influence what type of company we want to then own. Probably the ones that are less, you know, with less torque in terms of their operation. So even within the sectors, there's some room to maneuver on how we want to manage risk at the individual company level. So it's something that is can be done at a different with different levers at different levels, and the portfolio management process take that all in account. If I can give you an image, it's like using Lego blocks. Each stock selection is a Lego block. Even if you have identified a company that looks interesting, maybe it's not going to feel what you want to build. So maybe you're gonna just gonna left it aside for a while, gonna come back when you know the environment will be more favorable for that specific company. So once all those companies have been identified and even some more, that's when you start to build what you call the perfect portfolio, when you make sure that you know you optimize the return that you might get, but also the risks that you have.
I understand. So we mentioned that the track record on this strategy dates to almost a decade now. You've had enormous success in terms of performance. According to you, what has been the drivers of that performance? And maybe a word on how this strategy adapts to changes in the market, be it like small or bigger cyclical changes.
Um, I would say that most of the strategy, of the success came from stock selection. I would say at least three quarter, maybe even more. Compared to some other of my mandates, I tend to hold companies in the small cap longer. They're really there for you know the strength of their business model. It's company that you have sometimes to be a little more patient. Also, liquidity can affect you know the behavior of a stock significantly for several months. You know, there's a big seller. There's no action on this on the name. No one really takes a look at that name. You have to be very patient. But at the end of the day, you know, when things start to move in your direction and it turns out that you're right, you know, of course, return can be quite substantial. Like everybody else who made a couple of bad investments, that's for sure. We're not 100% perfect, but overall, you know, the average, we had a pretty good average. And something that helped us also through the years, and uh, for example, this year it's specifically the case, is M&A. We have seen a lot of our company being taken over. I must tell you that I've never buying a company in the hope that they're going to be bought. It's, you know, you never know when it's going to happen or if it's going to happen. So it's good company that I buy for price appreciation. But guess what? Often a bigger company, when there's a small one with a good, you know, access to market, a good technology or whatsoever, out there that you know really start to show itself like being you know able to play against the big boys, they are often been taken over. And usually premium are interesting. Sometimes they are a little disappointing. I've seen a couple of companies being taken over at a lower price than what I wanted, but you know that's also part of the deal. And like I said, maybe sector allocation or the macro analysis was more there to help me kind of avoid a couple of sectors being underweight at the right moment and, you know, not lose too much. Something that would have been probably regained somewhere in the future, but, you know, instead of putting our money there, we were able to put it somewhere else and then create more value right away instead of having to wait. So I guess that's more a little more like a defensive way of creating value and certainly a way of also reducing risk. But I think we were also successful on that front. And when you add all those things up, I think that's what helped us to create, you know, a fund with a tremendous, you know, track record, I think.
Thank you, Mark. I'd like to change gears a little bit, go a bit larger about this. Can you tell us about your outlook for the Canadian equity market in general, but also specifically for small caps?
Yeah, well, I think that right now we're at really an interesting, you know, juncture for small caps, because if you look at the economic cycle right now, we're at the end of a slowdown. We kind of have won, maybe not completely, but sufficiently enough the war against inflation to see short-term rates start to go down, and that's really the point where the market is willing to start to look over those you know earnings that are maybe not great because you know in a slowdown environment earnings are not, what's is the most exciting, but those rate cuts, they bring with us the promises like spring, that better days are ahead and that the economy will reflate and therefore profits will get better. So that's the time you see market expansions. And that kind of juncture is especially interesting for small cap because they usually suffered a little more during the slowdown, so they have even more to gain, in that reflation cycle. And also, if the inflation have happened to be synchronized around the world, like it is mostly right now, we're going to see Europe, cutting. We hope that China will solve, the difficulties that they have with their housing market. The Chinese government was out some days ago just mentioning that they really want to take some measure to go and solve that problem very seriously. They go after that problem. Um, so if they succeed, I think it's going to be very promising in terms of having this synchronized recovery. And commodities are important in Canada, and guess what? They are even more important in small cap index. The index is quite exposed, and that's probably where we are pretty comfortable to play in terms of portfolio manager, me and my team. And I think that's where we can distinguish ourselves. Some other portfolio manager out there in small cap world, they're a little more nervous to play commodities sometimes for whatever reasons. And I think that certainly put us a little in our, at our advantage, I guess.
Interesting. So we can see you're super excited about small cap. Maybe my question would be for you, like, why should investors allocate capital to Canadian small cap fund at this time of the cycle? And are there specific opportunities aside from the commodities that you've just spoke about that they should look at in this space?
I think that why do you want to invest in small cap? Usually, you want to invest in small cap for two reasons. The first one, I think, it's gonna bring some torque at your portfolio, and right now, it's really a good moment to bring some torque. And also, I think that if you look at the asset class, that's an area where your portfolio manager can create a lot of values, because some companies can will do tremendously well in that sector, and some other will lose a lot, sometime even go bankrupt. So if you can find, a portfolio managed in a way that consistently produce added value, you can end up with some quite interesting addition of return. And hopefully, if it's done with some consistency, and that's what we have been able to do, then it shouldn't increase your risk too much. So that's why I think it's really a good time to invest in small cap and to allocate capital there. Uh, what sectors? Cyclicals, as I said, I think it's an interesting moment. And from there, of course, you want to choose the best one. You want to choose the one that are, the most interesting at this point. And that's where I think, portfolio manager in that asset class can, bring you some added value.
Great. Maybe last question for you today, Mark, would be what distinguishes your approach from other fund managers in the small cap space in Canada?
It's probably, like a conclusion of a lot of little thing I touch, upon during this conversation. The first one is not afraid to be, to be invested in commodities because the index is quite present there, but doing it in a way that we can still use, still add values even when commodities are not, that that great, but for with a mix of stock selection and sector allocation, manage to still continue to create value. So that's certainly one of the thing that distinguish myself. The other thing is, and that allows me to beat the index on a consistent basis, by the way. And that happened over the years to help me beat the peers on a consistent basis. And that's what distinguished me. And you know what? If you can do that on a consistent basis, that's when you bring your risk lower. And that's also what also distinguished me for the others. So if we look at the past, and hopefully you find that 10 years is enough to be a track record that you can rely on, we've been able to do to tick all those boxes and be that kind of portfolio manager that can achieve those quite interesting objectives.
Yes. Well, thank you so much, Mark. This has been very interesting, and they were great insights. One thing I'd like to add as a heads up is that Mark will be marketing his fund in the coming weeks across Canada. So stay tuned.
It will be my pleasure to meet you if we can in person or whatever ways, and it will be certainly my pleasure to talk a little more about my funds in during those meetings.
Thank you so much, Mark.
Bye bye.